Good morning, everyone. Good morning, my dear students. And This is C. Ankit Sharma again, and we are over here to discuss the provision regarding capital gain. So once again, good morning. Sat Sri Akal, Namaskar. I hope you all are good, and of course, your studying is also going good. In our last session, we have completed the provision of PGBP, profits and gains of business and profession. That was a very huge chapter, and again, very important also. In the same way, we are going to discuss today the provision of capital gain, the income chargeable under the head capital gain. Again, it's a huge chapter, and again, it's one of the most important chapter also. So for numerical purpose, or we can say we have 5 heads of income. Salary head, of course, income from house property, then business head, then capital gain and income from other source. So you have already read the provision of salary, income from house property, PGBP, 3 heads. Now 2 heads left, like income from head of capital gain and income from other sources. So again, capital gain also very important for your examination. Very important, because it's a proper numerical provision, we can say. Almost numerical provision should be asked in the examination, but it does not mean that theory cannot be asked. Generally, in numerical topics, we focus on the numerical treatment of any head or any topic. But it's not the reality that only the numerical part is important. Theoretical part is also important. It can be asked in examination also. And one more thing, the theoretical part of any chapter, of any numerical chapter, is the basic foundation of that numerical topic. If you do not understand the theoretical concept of any chapter, you won't be able to solve the numerical also. So in PGBP or in salary head or in income from house property, generally what happened, students do not give much importance to the theoretical part of those chapters or topic. So please do not do this. It does not mean that theoretical part is not important. No. Please don't do this. Do not underestimate the power of a theoretical topic. Just like do not underestimate the power of a common man. The same way, do not underestimate the power of your theoretical provision also, because your whole numerical part is based on the theoretical concept. If you want to understand the concept of depreciation, if you want to understand the charting section of PGBP, if you want to understand how the format should be made, if you want to understand the meaning of salary, if you want to understand the meaning of annual value in the house property, if you want to understand the meaning of allowances and perquisite or compensation, so you are just reading the numerical provision, but you're not understanding it. So please do also give importance to your theoretical concept in every numerical topic. It will help you to understand the numerical more conceptual wise, of course, and more easily. And of course, institute can also ask questions out of the theoretical topic also in any numerical chapter and so on. So a lot of good morning has been received by me. Diksha, good morning. Bhumika, good morning. Sushil, Darshan. Okay. Gunnapalli, Sankaran, Komal, Para, Vishwanath, Reddy, and Darshan. Again, Darshan is asking something. What is the treatment of income tax refund, interest on income tax refund, and advance tax paid, sir? I guess you have 2 questions. If you have any income tax refund, then any interest received on income tax refund. Understand? If you receive any interest, department pay interest also on income tax refund. So if any interest portion has been received by you on any income tax refund, that is your taxable income. Okay, under income from other sources. Interest on income tax refund and advance tax paid. So in case of income tax, if you paid any interest on it, if you paid any interest, that is not going to be your expenditure. Only legal fees, etc. paid for income tax purpose can be allowed as expenditure. Otherwise, interest won't be allowed. But your interest received will be your income from other sources. That interest paid cannot be allowed as a business expenditure. Okay. So moving on to thought for the day, of course, as usual, we always discuss our thought for the day, and also I'll start sharing a small story as I shared in the last session. So I'll try to share a small stories in every lecture also that might be going to inspire you. Okay. So what is the thought for today? This is success is the sum of small efforts. Nobody is going to be successful in a single day. Whether it's a Tata company, whether it's Reliance company, whether it's Tesla, whether it's anyone who start that business, they always start from the scratch. They all work very hard day by day. So when you see someone successful, it's not a single day impact. It's a work he does day by day. Your small efforts technically make big difference at the end. So that's why you are studying every day. So the result will be you be a chartered accountant. So when you will be a chartered accountant, and if somebody is going to see you and say, wow, you are a chartered accountant, you are so successful, you are so having a reputation in the, of course, society. So it does not mean that you get this thing in a single day. You, of course, making efforts every day, technically every day for 3 or 4 or 5 years, we are making efforts every day. We sacrifices party, we sacrifices a lot of things to become a chartered accountant. So we all are actually successful, but behind that success, our efforts, small efforts matter. So always remember that the journey starts from a single step. So it doesn't matter how long the journey is, but it always starts from single step, then again a step, then again a step, then you can start running. So it's a small efforts what you are doing every day that counts, and that is the thing which will result in big differences. That was the thought for the day. I believe you all have downloaded the notes. I have uploaded those notes on the portal yesterday. So I believe you must have downloaded it. So we will start today's chapter, that is income under the head capital gain. So you have already studied the provision of 3 heads of income. One of which is income under the head salary. Income under the head salary will be those payment which is done by an employer to an employee. So if there is an employer-employee relationship, then the payment flow between this relationship from employer to employee will form part of salary head. Okay. Then it comes to income under the head house property. So if you have a building, and you are not using that building for your business or profession, you let out that building or it's self-occupied, etc. Then the treatment is in income from house property. Then we discuss the provision of PGBP, which says if there is any income which accrue or arise due to carry on some activity or do not carry on some business activity, in that case, that income will fall under the head business and profession. Clear? So we discussed provision till that over there in 3 heads. And the charging section was, PGBP charging section was 28, salary charging section was 15, and income from house property was 22. Now, capital gain charging section is 45. But before discussing the technical provision, let me discuss you with a very simple language that which income is going to be form part of income under the head capital gain. So the provision says that if you have a capital asset, what is the meaning of capital asset, etc., we will discuss. So if you have a capital asset and if there is a transfer, what is the meaning of transfer? Generally, sale, exchange, etc. We also have the definition of transfer. We will discuss it also. Okay. So if you have a capital asset and you are going to transfer it, so if these 2 conditions has been fulfilled, then the provision of capital gain chapter will be applicable. Generally, if you have a capital asset and if you transfer it in the previous year, then any gain arise from that transfer is going to be chargeable under the head capital gain in that previous year. So there must be two conditions which need to be fulfilled. That one is you should have a capital asset and you should have transferred it during the previous year. So if there is a transfer of a capital asset in previous year, then capital gain provision will be applicable in the previous year. So this head will be applicable. That means any income will fall under the head capital gain if at least these two conditions should be fulfilled. So we will start discussing what is the meaning of capital asset and transfer. As you all know the rules for the lecture, that we will take queries after 30 to 40 minutes. Please be focused. Please ask your queries which is related to the topic. You can ask your query in Hindi also. If somebody is going to ask any query in Hindi, I will explain, I will solve that query in Hindi. All other query, etc., will be, of course, in English only. Our tea break will be around 8:30. So these are the guidelines. These are the rules which I have already discussed in my last PGBP session. So I'm just telling for those if anyone joined today first time. You can send me queries whenever you want, but we will going to take those query only after 30 to 40 minutes. So this is capital gain. Quotation, of course, for the day: work hard in silence. Let your success make the. So just work hard and your success will speak. Okay. So income under the head capital gain. These are provision based on the study material provided by the institute, which is beautifully drafted. Fine. So part 1 and part 2 we are discussing part 1 provision. In part 2, we will be discussing exemption concept of capital gain. For the time being, we have the charging section, which is section 45, and says any profit or gain arising from transfer of a capital asset. The charging section says if there is a transfer, is there a transfer of a capital asset, then that chargeable to tax under the head capital gain in which transfer took place. So in the year in which transfer took place. So we discussed it. We need to discuss what is the meaning of capital asset and what is the meaning of transfer. Then we will be able to understand when the capital gain provision is going to be applicable. So at least two this condition need to be fulfilled. So the definition of capital asset is waiting for you. Under section 214, definition says, according to section 214, a capital asset means property of any kind held by assessee. Property of any kind held by assessee. Property means any kind of asset will be a capital asset if it is held by assessee, whether or not connected with his business or profession. So if you have any asset, whether it's using for your business or not, or it's a personal, still it will be regarded as capital asset. So technically we can say that point number 1 say all assets are capital asset, whether connected to your business or not. We have some exception that is going to come. Any security held by a financial institutional investor which is invested in such security in accordance with the SEBI regulations. So FFIs, they are investing in any securities which has been as per the SEBI guideline. That security is also termed as capital asset. Any unit-linked insurance policies issued on or after 1 February 2021, to which exemption under section 1010D does not apply on account of premium payable exceeding 2,50,000 for any of the previous year during the term of such policy. So we have three kinds of property which are going to be treated as capital asset, but the summary just say one thing: all assets are capital asset. We have the exception which we are going to discuss after this. So technically all asset which is used for business or not your asset, if any securities held by FFI as per SEBI guidelines, that is also capital asset. And any ULIP plan which is not exempted under section 1010D, that is also going to be treated as a capital asset. Now, what is not capital asset? That is much more important. So we will be seeing now what is not capital asset. So this is exclusion is more important in this case, but does not include the followings. What is not including? Let's see. Any stock in trade, any stock in trade. So any asset which is in business as an asset is a capital asset, but stock in trade is not a technically asset in the business. So any stock in trade of business carried on by an SSC will not be treated as capital asset. Why? Because the transfer of this stock is going to be treated as PGBP sale. So if you have any stock in trade, that is not termed as capital asset because the treatment of transfer of that stock is going to be in under the head PGBP. So it cannot be treated under the head capital gain. For example, understand any stock in trade is not a capital asset. For example, there is Mr. A. He is a builder. So what is his business? What is his stock in trade? His stock in trades are buildings. So if we transfer these buildings, then PGBP provision will be applicable, not capital gain. So his buildings are, because they are treated as stock in trade, so they cannot be treated as capital asset. But if there is Mr. B, who is a salaried person or doing business of shoes, and if he has a building, his house, and if he transfer it, now because this building is not his stock in trade, so now the treatment of this building will be under the head capital gain. Even if Mr. A is having a house, his residential house, so that house is also is not his stock in trade, that is his asset. So if we transfer or sell this house, then the treatment will be under the head capital gain. Clear? So if there is a jeweler, for a jeweler, jewelry is stock in trade. So if we transfer this jewelry, then the treatment will be under the head PGBP. But if I have some jewelry, that is not my stock in trade, that is my asset. So if I transfer the jewelry, the treatment will be under the head capital gain. So if there is any asset which is your stock in trade, the treatment of that asset will be under the head PGBP, so it cannot be treated under the head capital gain. It's very simple, I guess. Clear? So these are the assets which will not be treated as capital asset. Exception number 1 was any stock in trade. So if there is any stock in trade, that cannot be treated as his capital asset. Second is personal effect. That's very important. It says if you have any asset which is movable asset, including clothes, furniture for personal use. So two conditions should be satisfied. It should be mobile. It should be for personal use. So technically, building cannot be a form part of this exclusion because building is immobile. Land is immobile. So only those capital asset or those asset which is for personal use and those are mobile, they cannot be treated as your capital asset like clothes, furniture, etc. if they are for personal use. like your television, your car, your refrigerator, etc. They are not capital asset. Now, income tax is very smart, of course. Is very smart. And when you will read the provision that the furniture, your television, your air condition, your etc. household things are not capital asset. It means if you transfer these assets, then there will be no capital gain chargeability on transfer of these assets. So you might be feeling very happy that, wow, if I'll transfer my TV, if I'll transfer my laptop, which is my personal use, if I'll transfer the furniture of my house, then I need not to pay any tax because that is not a capital asset. But it is not so, because income tax is far smarter than us. Why? They make the provision like this. It's a reason behind it. Suppose if you bought some furniture for worth rupees 1 lakh for your personal purpose, for your residential house, etc. If these assets are in the business premises, if it's a business asset, that will be treated as a capital asset. So, movable things plus if it is for personal purpose, only that is excluded from the definition of capital asset. Now, if you bought a furniture in 2020, for example, and if you are selling it in 2022 in our current previous year, so the selling price will be higher than 1 lakh or lower than 1 lakh? It's a very simple question I am asking to all of you. Kindly let me know that if you bought a furniture or television or a laptop or a refrigerator or an air conditioner or a microwave or a mixie grinder or an iron, etc., etc., whatever household thing you can think about. So if you bought in 2020 for 1 lakh rupees, and if you are selling that property in 2022 in previous year, then generally what we are going to receive the value will be more than 1 lakh or less than 1 lakh. Answer me. I am waiting for your response. Of course, the value will be lower. Of course. So when you will be going to calculate the capital gain is nothing. It's just a profit or loss on transfer of a capital asset. So there is capital gain, capital loss term we are using, but technically you have been already studied these things in the accounting. In accounts, when we sell any asset, if it is a loss asset, we show loss on sale of asset. And if it's in profit, we write it down, profit on sale of asset. So technically, capital gain, capital loss, just tell the profit on sale of any asset or loss on sale of any asset. So technically, when we sell this furniture after 2 years, the value will be less. Assume it's 60,000. So is there any profit on sale of asset or loss on sale of asset? What arise, loss or profit? It will always be loss. There will be no profit on sale of any mobile asset which is for personal use, except in some exceptional cases. So there will be technically always loss when you sell your any mobile plus personal asset. So if on sale, we write it down, sale price 60,000 less cost 1 lakh. So there will be a 40,000 loss on sale of this capital asset, which we should call capital loss. Now, if you sell any other asset and the sale price is 1 lakh, any other capital asset, those assets, those are not for personal purpose. And on sale, the cost was assume 70,000 and you earn profit 30,000. So this profit is going to be set off out of this loss. It's going to be set off. There is a chapter of set off of losses. So technically, this 40,000 loss is going to be set off out of this 30,000 capital gain profit. And income tax knew that if any personal asset is going to be transferred, which is for movable and personal asset, there will be always loss arise. And this loss you are going to set off from your other income. So income tax will be decreased because if this loss is not there, the income will be 30,000. And if loss is here, now there will be no income, there will be still 10,000 rupees loss left. So if department allow the definition of capital asset to include movable and personal asset, then there will be always loss. And that loss will be set up from income of the assessee. And due to this, his tax liability will reduce. So what they smartly do, they say we will not treat any movable asset which is for personal use for include in the definition of capital asset. So when you think, yes, it's very great provision that we will transfer our furniture, television, laptop, and profit is not going to be taxable. So let me tell you, my future chartered accountants, that there will be no gain. There will be always loss. And just to increase the tax, just to avoid the decrement in tax, income tax, not treat them as capital asset. So if you have any doubt upon my vision, let me see you that yes, that was the true intention of department, to stop the loss to set off from the income. Because what they did, they exclude some personal asset which are movable. So initially they say that all personal effects which are movable, we will not treat them as capital asset. So the intention was there will be no gain. So why we should treat them as a capital asset? Because in that case, there will be loss which will be set off against assessee income. And you can see the intention because they say all personal assets which are movable are not capital asset, but except these point number A, B, C, D, E, F. These also personal asset and movable. But income tax is going to treat these 6 personal assets, those are movable, as capital asset. Why? Because in these personal assets, the value is increased after the time of purchase. The first one is jewelry. Understand? If I'll say that somebody has purchased, jewelry for 1 lakh rupees in 2020, and if now he wants to sell it, then that in normal case the value should be always upside. So there will be always gain in case of jewelry. That means in this case there will be no loss. So those personal capital asset, those are movable and personal, but there the increment in the value after time. So there will be always gain. So those personal and movable is treated as capital asset, and those personal movable in which always loss will arise is excluded from the definition of capital asset. So you now get to my point that the intention was to only include those capital assets, the value is increased after time. That's why they did not include immovable asset, which is for personal use. That is land and building, because after time, their value always increase. So those personal assets which are movable, which will provide government gain, these are still capital asset. Exception is, you can see jewelry value increase after time, archaeological collection, of course, drawings, paintings, sculptures, that is statue, etc., or any work of art. So technically, we can say that from B to F, they are called antique things generally. Okay. And jewelry, of course, after time, the value increase. So these 6 assets are personal and still movable, but these are going to be treated as your capital asset. So on transfer of these assets, capital gain provision will be applicable. Other than these 6, if this is personal and movable, there will not any capital gain chapter applicable because these are not capital assets. Clear? So there is jewelry, we all know the meaning, archaeological collection, of course, they're kind of antique cheese, drawing and painting, the value increase after time, and sculpture or any work of art. So anyone of you can tell me the meaning of the difference between drawing and painting? I am giving you 30 seconds to tell me the difference between drawings and paintings. Let's see if somebody has the answer of this. What is the difference? It's a very simple difference. What is the difference between drawings and painting? It does not matter under our capital gain topic. Of course, the treatment of both are same because they will be treated as capital asset. But just for knowledge, just for the way you should study, you should know the meaning of everything you study. That's the way you can be really more easy to you to understand the concept. If you know the meaning of drawing and painting, archaeological collection, etc., that will actually create interest in your study also, and that will be really helpful also. So drawings are made by us and painting by others. Darshan is saying drawings are made by us and painting by others. Very well done. It's a very funny answer, but still you are trying. That's matter. I always believe if you try, whether it's wrong or right, does not matter. Your effort technically counts. Those who are not trying is technically not going in the right way. So if any asset transfer from gift, I'll answer these kind of question. Paintings will be colors and painting need not. Okay, you are trying to write the correct answer. General difference between a drawing and painting is in paintings, generally there is a use of brush, color, etc. In case of drawing, generally there is no use of brush, etc. There will be kind of sketches, okay? But it does not matter, just for time being we discussed. So, first point says stock in trade will not be your capital asset. All personal effects, those are movable, not your capital asset, but there is exception A, B, C, D, E, F. These are personal and movable, but still going to be treated as your capital asset. Agricultural land situated in rural area. So if you have an agricultural land situated in rural area, that is not going to be treated as your capital asset. What is the meaning of rural area? That must have been discussed with you in chapter number 3. That is a specific limit, that is population is 10,000, then that area and 2 kilometers. Then if population is more than 10,000 and 1 lakh, then I guess it's 6 kilometers. If it's more exceeding 10 lakh, then it's 8 kilometers. So any area outside that area will be rural area. So if you have any agricultural land, understand that land should be used for agricultural purpose. And if you transfer that land, that is not a capital asset. If it should be an agricultural land and situated in rural area. Point number 4 and 5. They talk about the same thing. They say all securities, shares, debenture, etc. All securities are capital asset. All securities are capital asset except these two. So except point number 4 and 5, all shares, debentures, bonds, etc., etc., etc. are capital asset. But these point number 4 and 5 bonds, these are not capital asset. That is 6.5% gold bond, 7% gold bond, national gold bond, special bearer bond, etc. Gold deposit bond issued under gold deposit scheme, gold monetization scheme, etc. notified by the government. So these are not capital asset. So we just need the definition of capital asset. Moving on further. Just a second. So what is concept of capital gain? If your purchase price is less than sale price, where will be gain? Of course, if your purchase price is less and your sale price is higher than your purchase, then it will be capital gain. And if it's vice versa, that purchase price is more than your sale price, there will be capital loss. Technically, we can say if there is profit on sale of asset, it is technically capital gain. And if it's loss on sale of asset, it is a capital loss. But we cannot use the word profit or loss. We need to use the word capital gain or capital loss. I personally believe that on all heads of income, all other heads of income, the formats are huge. The most easiest format for the purpose of calculation under all heads of income, except income from other source, but technically there is no format. So these four heads, that is salary, house property, business, and capital gain. Out of these four heads of income, the easiest format, the simplest format is under income under the head capital gain, because we just need to find out profit on sale of asset or loss on sale of asset. And how we can find out the profit or loss on any asset? That is sale minus purchase. So it's not that simple that you just need to take the sale and reducing purchase, but the basic concept is this. And technically the format is too easy in comparison to other provisions. So there will be sale consideration which will be given in question. That means what we received, monetary, non-monetary, etc., the value of that consideration we need to put over here as sales consideration. First thing. Next, second is expenses on transfer. That means commission, brokerage, etc. So if any expenses on transfer has been incurred, that is going to be deducted as your expenses on transfer. That is also be there in the question. So the sale consideration will be given in question. The expenses of transfer will be given in question. So after deducting the expenses out of sale consideration, we will find our net sale consideration. That means this is the net value which comes to our account or in our pocket, etc., after deducting the expenses on transfer. So this is technically our receipt. Now we need to deduct the cost of acquisition. That means purchase price of that asset. The cost of acquisition or index cost of acquisition. What is the meaning of index cost of acquisition? We will be not discussing that right now. We will be discuss this topic in detail later on. So for time being, you can skip the meaning of index cost of acquisition. We will discuss it in detail. Do not worry. So out of the net sale consideration, what we just need to deduct? The expenses done by us on purchase of that capital asset as cost of acquisition, cost of improvement or index cost of improvement. After purchase of any asset, if you have done any expenditure, as you purchased a building for rupees 60 lakh, but after purchase, you construct something new in that building, change the flooring, etc. That is called cost of improvement. So that is any expenditure after purchase in any asset. That is called cost of improvement in capital gain chapter. So cost of improvement and again index cost of improvement. So index concept we will going to discuss later. That is going to be deducted. So this is purchase price. Cost of improvement, that is capital expenditure after purchase. There should not be any revenue expenditure. For example, if you purchased a building and construct a new room for 10 lakh rupees, that is cost of improvement. But if you expenditure is for repair, whitewash, etc. for rupees 1 lakh, that is not our cost of improvement. Only capital expenditure, which is after purchase of any asset, will be treated as cost of improvement. So after that, we will be our either long-term capital gain, short-term capital gain, that means long-term profit or short-term profit, or either long-term capital loss or short-term capital loss. Long-term loss or short-term loss. How it is long-term and short-term, that will depend upon asset. If asset is long-term capital asset, the gain or loss will be long-term. If the capital asset is short-term, then the gain and loss will be short-term. How we can find out the asset is long-term and short-term? The definition of long-term asset and short-term asset also we are going to discuss after this topic. So you can see that this format is basically saying two things. that whatever you received on transfer, that is your receipt. Write it down. And whatever expenditure you have done from purchase and after that purchase, the cost plus expense need to deduct. There will be capital gain or capital loss. So technically, the format is again very, very simple. It just say whatever you received on transfer, that is your net sale consideration. And whatever you have expended on this capital asset at the time of purchase and after that, that is your expenditure. After that, you will have your answer. So now the definition of capital asset we have just discussed. We discussed the format and we are moving on to the definition of transfer. But before that, let me take some queries which has been asked by you. Okay, let's see the question. Darshan is asking, if I buy a share today and sell it tomorrow at a profit, it is chargeable here? Yes, it might be chargeable here because it should not be your business kind of transaction. It should not be your intraday, etc., or your frequency of transaction. If you purchase a share today and sell it tomorrow, and if it is not your normal business, then in that case, if there is any profit arise, then yes, it is going to be taxable under capital gain. Because if you frequently deal in shares, sale and purchase of share, then that will be treated as your business. Then share will be your stock in trade. But if generally I purchase today and I sell tomorrow, that is your capital gain and it's going to be taxable under this head. Sushil Kumar was asking, please sir, distinguish between stock. I explained you the meaning of stock, of course. If there is any problem, please, Sushil, ask me in detail because your query is just this. Please, sir, distinguish between stock. So stock, that means business stock in trade, what we were discussing. Okay, Mr. Shreyas is asking, sir, if mobile property is for business purpose, then they consider this capital asset. Yes, I also explained this also. That yes, if your mobile asset is for business, if furniture is in your office and factory, if computer, if TV, if refrigerator, etc. in your office or factory, yes, they are capital asset. On their transfer, capital gain will arise. We have the separate provision regarding capital gain in case of depreciable asset under section 50, in which we will discuss this provision in detail. Okay. Next is Bhumika is asking, sir, if any broker sells shares under SEBI regulation to an individual, this will not be a capital gain. The question is, Bhumika, technically not right. If the broker sells shares and if that is his stock in trade, if that shares is the part of that broker's stock in trade, generally don't it not the part of the is stock in trade. Because broker just charged commission from me. I gave him order and he transferred me share out from the stock exchange and I pay him commission. But if you're asking might be like this, so if broker is transferring his share, which is his stock in trade, then treatment will be under PGVP head. And if broker has shares as his capital asset, then treatment will be under capital gain. So it depends that your securities, that your shares, that your investments is your stock in trade or capital asset. So if you regularly or frequently deal in share, security, etc., that is technically your stock in trade. So there is no specific definition of regularity or frequency. But because the stock means in which we generally trade. So if we generally trade in share, security, etc., those transactions, those shares are your stock in trade. Otherwise, it's your capital asset. So if any broker sells share under SEBI regulation to an individual, this will not be a cap gain. This will be a cap gain. I just explained it to you. If it is stock under PGVP head, if it's not stock, if the shares are capital asset of that broker, then it will be a capital gain. Okay, next drawings has been done. Okay, Abhay was asking if any asset transfer in form of gift, then capital gain or loss is there or not. So gifts are technically exempt from capital gain. So if you gift any asset to anyone, there will be no capital gain. But just stay. After listening this, do not gift anything to anyone because there is a different concept also. So at the time of gift of capital asset, that is exempted, but there is a separate concept. We have the provision regarding gift, will, etc. under section 47. But yes, for time being, I can answer this that yes, gift is exempted, so there will be no capital gain at the time of gift. Okay, next is drawing solution has been there. Okay. Drawings is lines. Okay. Painting is done by painter, but drawing done by engineer expert, not colored. No, I just explained the meaning of drawing and painting. Okay, next, somebody is asking. Vaishali is asking, sir, if shares in that sale is somebody business, then also cap gain? No, I explained you, Vaishali, just right now. If your business is, normal business is selling shares or debenture, that is your business. Sudhanshu is saying gold loans on which rate of interest is other than 6.5 or 7 will fall under capital gain. Yes, it will fall under capital gain if it is not notified by the government. ULIP is unit link insurance plan. It's kind of an investment plan for insurance purpose. So that is a kind of also, if you have ULIP units, then it will be treated as your capital asset if the insurance premium is not exceeding 2,50,000. It's a kind of a security. You can understand. Mutual funds. Okay. Shreyas is asking, Mr. A sells a capital asset and the agreement has 9 lakh as the value of asset, but he received 2 lakh in that year and the balance is due to receive. Then what amount to be considered as sale consideration? Full 9 lakh. Shreyas, just wait for the time when we will move on to our numerical part. So these questions are not yet you should ask. You should ask question what we just discussed till now. So till now we discussed the definition of capital asset, charging section 45 concept and the format. So your query should be related till now because you are asking me query which will be covered later. So you might have already read this chapter somewhere else. So if I'll try to answer your query, the other student will not be able to understand because we are not still discuss the numerical part of capital gain. So just wait, just have patience, relax, enjoy the studies. I will answer each and everything. I will discuss each and everything. And you might be seeing all of you that whatever query you send to me, before taking that query, a lot of query I already discussed before the query I start taking. So because I know what kind of question you all are going to ask, so you can send me query, but let me solve only those query which is related to topic what we are discussing till now. Otherwise, it will be a really mess if I'll explain the later topics over here. Okay. So 9 lakh of the value, but for timing, I can tell you, yes, the full 9 lakh will be taxable over here because under capital gain also, the accrual concept has been, even if you did not receive anything, still it's going to be taxable full. Same as in case of salary. It's accrue or receive, whichever is earlier. Okay. Vaishali Vindal's a business of property dealer including property dealer is kind of a commission agent. So builder, if dealing in buildings, that is stock in trade. A property dealer technically search Mr. A who has a building and search Mr. B who is the buyer. He just made those person in charge his commission. So he does not own that property. So his business is commission. Property does not belong to a property dealer. That commission income will be his business income. So there is no concept of capital asset in there. क्या पूछ रहा है बच्चा सुशील बेटा क्या पूछ रहा है Dear sir, stock and trade, what does that means? तो पूछो. Sushil, you are asking, please sir, distinguish between stock. Distinguish stock with which thing? You should tell me, na? Distinguish between stock and, there must be a complete sentence, na? Stock and what? Stock means stock and trade. Either I am not able to understand or you're not explaining your question in full. Okay. यूलिप का क्या मतलब होता है ओके मैंने हिंदी में आंसर नहीं दिया यूलिप का मतलब एक तरह का म्यूचुअल फंड है एक तरह का इन्वेस्टमेंट है एक तरह की सिक्योरिटीज है और यूलिप में जो मिलने वाली इंश्योरेंस प्लान है उसमें अगर 2.5 लाख से ऊपर का आप प्रीमियम देते हैं तो वो आपकी कैपिटल एसेट मान लिया जाएगा। नेक्स्ट इज Kavita is asking, sir, every question I solved, I had 2-4 lackings in PGBP. How would it will be overcome? Every time I was missing at least 1 point. It's a very good, I guess, query you asked, Kavita. In PGBP, it happens. But remember, the PGBP question will be almost 8 or 9 or 10 marks in the examination. So even if you are not able to solve one, or if you are not, solving it wrong, still you are going to get very good marks because it's a step marking. So there might be issues because in PGBP, a lot of provision is actually is applicable in a single question. Due to the huge topic, there might be in a single question 10 or 12 or 15 provisions are applicable in a single question. So it might be that you are not able to solve the all question, but just remember, at least you, if you are able to solve 80 to 90% PGBP question correctly, that's good, and you can practice more, and I believe you are able to solve 100% question later on. There is no magic I have. You just need to learn the provision again and again, and you have to practice more. Next is Man Lodri. I just told you that 6.5%, 7% gold bonds specifically mentioned. If there's any other rate gold bonds in the examination, you can treat them as a capital asset. Fine. Diksha asking, why do gold? Because it is a scheme framed by the government. These bonds are issued by government, and to make them more popular. How it will become more popular? Because the interest rate is really low. How it become more popular? Because government say, if you will buy other debenture bond and if you are going to sell it, there will be capital gain. But if you buy these gold bond and if you will transfer those bonds in future, there will be no capital gain. So just to make them popular, government provide this kind of benefit. Mortgaging is not technically transfer. We are going to discuss definition of transfer. So transferring anything via mortgage, loan as a security, that is not included definition of transfer. So that will be no capital gain in these cases. We have a concept of reverse mortgage also, in which you will be able to understand this in detail. Okay, next is Varsha. Sushil may be confused, talk of bunch of shares, security, etc. That's very good, Varsha. That the Sushil query you are telling me. Sushil may be confused with talk of bunch of shares. If you, I just told you, Sushil, if your query is this, that if you have a lot of shares, it does not matter the shares are less or more. It depends on frequency of transaction. If you frequently deal in shares transfer and purchase and transfer and purchase, then these are your stock in trade and the treatment will be under PGP. Else it will be in capital gain. Okay, so Danshu, vehicle will exclude from capital gain as it used for personal and mobile property or its value decrease. Is it okay? If that vehicle is for personal purpose, that is going to be excluded. And because exactly when you transfer it, then there will be loss. And department income tax does not want that. Yes, but if your vehicle is a part of your business, then that is a capital asset. On transfer, we will see how to calculate the capital gain or loss. Okay. So till now we discuss all the queries. Moving on to the definition of transfer. So transfer definition says that transfer says, as per section 247, transfer for the purpose of capital gain includes following. So generally transfer, we understand that kind of sale, etc. But that's a huge definition of transfer. Transfer is a huge definition, wider scope. It includes sale also. It includes exchange, relinquishment. So if you transfer anything and in consideration you receive monetary payment, that is called sale. If you transfer any asset and against that asset you receive anything non-monetary, that is in kind. That is called barter system. Again, that exchange is also treated as transfer. So for the purpose of capital gain, if we will see what will be the sale consideration, for solving the format, we should have sale consideration. So if I say that you sell the property, then the monetary value will be your consideration. That means for sale, we will take the monetary value in place of your sale consideration. If that is exchange, then for the purpose of exchange, the asset we receive, whatever we receive in kind, whatever. In case of exchange, if I have jewelry and I transfer it, and against that jewelry, somebody gives me the shares or securities, then whatever asset I receive, the fair market value of that asset will be my sale consideration. So if I transfer my jewelry and receive the securities, shares, etc., then the fair market value of securities or shares at the time of transfer will be my sale consideration. Clear? Relinquishment means gift, etc. Relinquishment grammar meanings to waive your right on any asset. If I gift my jewelry to someone, that's called relinquishment. So if someone is transferring his asset voluntarily, then in that case, that is called relinquishment, and because it includes under the definition of transfer. So there will be capital gain chargeability. So problem is this: if I transfer my jewelry to someone for free, then whatever is the sale consideration, whatever I will receive, technically nil, because I gift that property to someone by way of gift or will, etc. So in case of relinquishment, there is technically no sale consideration, that will be zero. But there must be cost. The format say you need to deduct the cost out of the sale consideration. Let me explain you in the separate sheet. That will be really helpful. So we are discussing the definition of section 247, transfer. And our format says to calculate capital gain, we should have sale consideration and cost, which might be index cost of acquisition, etc. But in a simple form, we can say this is the way to calculate our capital gain. So in section 247, the first point say if you sell any property. So if you are selling your property, then the monetary value will be your sale consideration, and whatever cost you have incurred, your cost. So there will be capital gain or loss. I'm just trying to show you that in case of transfer, different situation, what will be your sale consideration? Clear? In case of exchange, the sale consideration will be the fair market of value of that asset which we received. That fair market value will be your, of course, sale consideration, and cost, of course, the asset you purchased earlier, that will be your gain or loss. Now, the meaning of relinquishment. The relinquishment grammar meaning is to waive your right on any asset. Waiver. That means voluntarily leaving your right on asset or voluntarily transferring any asset to anyone. But for the purpose of income tax, for the purpose of definition of transfer, they include waiver and destruction of asset over here. So if there is asset destruction, that will also be treated as relinquishment under the definition of transfer. For example, first of all, we will discuss the waiver concept. So waiver means gift, will, etc. So if you transfer any asset by way of gift or will, that means voluntarily, we will call it relinquishment. Now in this case, sale consideration will always be nil. But because there is a capital asset, for example, there is a house, what you purchase for 60 lakh, and you gift this house after some year to someone for free, of course. Gift means free. So if Mr. A transfer this house, then for the purpose of Mr. A, sale consideration will be nil. Clear? Because there is no consideration. But cost is there, of course. It will always have. Cost is 60 lakh. So there will be a loss. And technically, listen to me carefully. In case of gift, will, etc., there will always be loss. Always. Because sale consideration will always nil. Whatever cost you will have, there will be always loss. And whenever there is loss in capital gain, income tax says what we should do. Because if there is loss due to gift, and if you have profit, then you need to set off it. So they include the gift in the definition of transfer. So that means capital gain charging section 45, both condition fulfill. There is a capital asset and there is a transfer. So we need to calculate the gain or loss, and it always be loss. But if there is loss, the department will be loss. So department what did? They just exempt these kind of transaction under section 47. So read it carefully and understand the whole concept. Like for personal asset, those are movable. There is always loss, but that's why they did not include furniture, etc. in the definition of capital asset. So charging section 45 not applicable in case of personal asset. Those are movable because they are not as capital asset. Clear? So if in question it has been asked that there is furniture worth rupees 2 lakh purchase price and we sold it for 1.5 lakh. So there is loss of 50,000. So is it a capital loss? The answer will be no, because there is no applicability of capital gain chapter because furniture is not capital asset. So in the MCQ, etc., if it has been written that one option is your capital loss 50,000 and one is capital gain not applicable. So correct answer is capital gain not applicable. Understand? Because these are not capital asset. But if the same question is asked for this, that there is a building which has been gifted to someone and the loss arises 60 lakh. In both cases, there is loss. But this loss is not a loss technically because section 45 is not applicable for furniture. But for this section 45 applicable because you have a capital asset and you are transferring it. But that is exempt under section 47. These are transfer which are not regarded as transfer under section 47. So technically, I am telling you that is exempted, but we will discuss the definition of section 47. So this transaction satisfied the basic condition of section 45, but they know that that is not in the gain. There will be always loss. So for the sake of saving that loss, the department exempt these transfer under section 47. So if the question asks about this, that whether it's a capital loss or not, then we will write it down. These are not transfer as per section 47. And for this, we will write down these are not capital asset as per the definition of capital asset. So they are having same treatment technically, that department does not going to allow these losses, but the concept is different. Okay. Now the destruction of asset. So if you have a building and it is destroyed by fire, etc., then there will be two situations. If there is insured building, if destruction happens, your asset destroyed. Then if there is insurance, then sale consideration will be insurance compensation, of course. Whatever compensation you will receive, that is your sale consideration, less cost will be deducted. It will be your gain or loss. But if no insurance is there, then there will be loss always, and department will not recognize that loss. So if you insured your building, if you insured your asset, and there is loss or profit due to insurance, In this case, again, there will be always loss. Because if the asset value is 10 lakh, it has been destroyed, then the compensation cannot be exceeding 10 lakh. It will be always less than 10 lakh. So if 10 lakh building has been destroyed and compensation is 8 lakh, cost is 10 lakh, there will always be loss. There will always be loss also in this case when you have insured that asset. But this loss is allowed because technically you are suffering from loss actually. In case of gift, you voluntarily create this loss because you transfer your asset voluntarily. But in case of destruction of asset, you already insured that asset. So you take all the steps to cover the loss. And still, if you are having loss, department say, yes, we will recognize this loss. This loss can be claimed as set off. But again, if you did not have insurance, then that means you are not serious for your asset. So in that case, there is always loss, but this loss again will not be treated as your loss. So department is very, very smart. Understand that, okay? So moving on to our provision. So your sale, exchange and relinquishment, waive right. Now the second point is different from relinquishment. If there is any asset and we voluntarily transfer it, that is relinquishment. But if we have any asset and if our right has been confiscated, that is confiscation of right. That we have asset, but somebody confiscated our right legally. It's not forcefully, it's legally. For example, we purchase a car on loan and we were not able to pay the installment later on. So what will happen? The bank personnel will come and they will take away that car from us, and that is legally they're allowed to take away. If we took loan on a building and we are not able to pay the installment for building, then what will happen? That building right of ownership will be confiscated from us. So that is also be treated as transfer. So we can say if we bought a car or we bought a building and took a loan, and loan was 50 lakh. For down payment or installment, we have paid only 10 lakh rupees as repayment of loan. And now this building has been confiscated, then sale consideration will be zero because on confiscation, the bank is not going to pay anything. Whatever we have paid on that building yet, that will be my cost. So there will always be loss. And this loss has been recognized by the income tax. This loss you can claim for the purpose of set off, etc. Compulsory acquisition under any law. We have the separate detailed provision regarding this compulsory acquisition. So we will discuss the concept of the meaning of compulsory acquisition later on when we will discuss the detailed provision for this. Okay. So for time being, I am skipping this topic. That is compulsory acquisition. For time being, I can tell you if government acquired your property compulsorily due to any reason, for making airport, for making road, etc. That is also transfer. On that also we are going to calculate the capital gain. What is the case? What is the concept? How we need to calculate? We will discuss in detail. Same conversion of capital asset into stock in trade of business. If you have any capital asset and now you are converting your capital asset into your stock in trade, then also that is regarded as transfer. How to calculate, etc. We will be discussing it. For the time being, we are just telling you that if you have any capital asset and you are converting that asset into stock, capital gains concept will be applicable. How it's going to be applicable, we will be discussing in detail. This is section 45.5. For compulsory acquisition, there is section 45. Next point number 5 says that it says if transaction involving possession of immovable property in part performance means without registry. Generally, in case of land and building, the ownership transfer at the time of registry of that property. So at the time of registry only, capital gain concept can be applicable. For example, if there is Mr. A who has a building, he wants to sell it for 80 lakh rupees to Mr. B, who wants to buy it for 80 lakh rupees. So Mr. B has paid 80 lakh rupees to Mr. A, and Mr. A transfer this building to Mr. A. B, sorry. But registry has not been made. So Mr. B got the possession, Mr. A got the money. But registry is yet to be done. That is called part performance. Something has been left. That is, registry not has been done yet. So capital gain can only be charged only when the transfer complete, ownership transfer. But in this case, ownership does not transfer, but both A and B got what they want. B want that house, so he got the house. A want the money, so he got the money. But government did not receive any stamp duty as well as capital gain in this case. So government needs to wait till the time of registry. That will be technically a deferred tax in case of government. So government will wait when both assessee has received what they got. So income tax made a new point under point number 5, and it says if the property possession has been given to the buyer, if the money has been received by the seller and registry has not been made, so we do not need registry. If the possession and money transfer has been done, we will treat it as a transfer. We will treat it as transfer. So that means in the year in which B got the possession, A got the money, now department will get the tax of capital gain in that year. So even if registry has been done after 10 year, 20 year, it does not matter. If in 2020 to 23, B got the money, A got the money, B got the house, then the government will also charge capital gain in only this year. Understood? Here is example, Mr. A enters into an agreement for the sale of his house. The purchaser gives the entire sale consideration to A. A hands over complete right of possession only, okay, to the purchaser since he has realized the entire sale consideration under Income Tax Act. The above transaction now is considered as transfer. Even legal title did not transfer yet. I believe you must have read the definition that is deemed owner under section 27 under income from house property. You have remember that? In that definition also, this case is there, which says that Mr. A transfer possession right to B and B transfer money to A. But registry is not still in the name of B. A give the possession of a house to Mr. B. B transfer money to Mr. A. So registry is still in the name of Mr. A. So title owner is Mr. A technically. So under income from house property, again, under section 27, the concept of deemed owner is there. And this point number 5 and 6, both are there also. So can you tell me who will be the deemed owner in this case? If you have read the provisional section 27, if that has been discussed with you, then the faculty must have told you that in this case, who will be the deemed owner for the purpose of income from house property? We do not have anything for capital gain. Capital gain is going to be imposed upon, of course, Mr. A because he received the amount. But I am asking that who will be the deemed owner in this case, A or B, for the purpose of income from house property. For example, if from that building Mr. B is earning any income, then who is the deemed owner? Let's see, any of you can answer me. Of course, Ms. Bhumka, well done. High five from Wi-Fi. Sudhanshu, high five. Of course, the B will be the deemed owner. So the same concept is income from house property, which correlated under section 247. So under income from house property, it was talking about B. And now in this chapter, we are talking about from Mr. A point of view because A needs to pay the capital gain. The same concept in point number 6. Any transaction by way of becoming a member, acquiring shares in a cooperative society, etc., which has the effect of enjoyment of any immovable property. Again, the same case, if you becoming a member of a cooperative society and gives the consideration to that cooperative society, and cooperative society is giving you a building which is equivalent to the consideration paid by the member. So that will also be treated as transfer, and the person who gave the money to the society or the company will be treated as team donor, and that company society needs to pay capital gain in the year even without registering. Same concept. A person may become a member of a cooperative society, company or other station which may be building house, let, etc. When he pay an agreed amount, the society, etc., hand over possession of the house to the person concerned, no transfer is registered. Still, even in this case, capital gain will be charged in the year of possession, etc. So, we have completed the definition of transfer now. Now, moving on to the provision, long-term and short-term capital asset. In the format we discussed whether the gain will be long-term or short-term. So when will be the gain will be long-term or short-term depend upon the nature of capital asset. If it is a long-term capital asset, the gain or loss will be called long-term. If it's a short-term capital asset, the gain or loss will be treated as short-term. Clear? So we are discussing what is the definition of long-term capital asset. What is the meaning of long-term capital asset? So what is long-term capital asset? It says in case of listed securities, if your securities are listed on stock exchange, then after 12 months, if you transfer those security, for example, I purchase listed security this year and I sell it after 12 months, exceeding 12 months, up to 12 months, this condition will not be fulfilled. So if you have listed security like listed preference shares, debenture, mutual fund, etc., etc. So if you have any listed security and if you transfer this security after 12 months, that will be a long-term capital asset. Clear? If this is unlisted share, if you have transferred unlisted shares or immovable property, that means land and building. If you have any land and building and unlisted shares, and if they transfer up to 24 months, and if they have transferred after 24 months, they will be called long-term capital asset. And for any other asset, if they transfer after 36 months, they will be called long-term capital asset. So the concept is very simple. If you have listed security, transfer after 12 months, that is long-term. So technically, logically, when they will be short-term, if they transfer less than or up to 12 months. So if listed security has been transferred less than or equal to 12 months, that will call short-term capital asset. Clear? If unlisted shares and land and building is transferred after 24 months, that is called your long-term. So when that will be short-term, if equal to or more than less than 24 months. So if you transfer any building after 1 year, 1.5 years, etc., that will be your short-term capital asset. What is short-term capital asset, which is not long-term? That will be automatically short-term. So if in case of listed security, after 12 months, it's long-term, then that means up to 12 months, that is short-term. Unlisted shares and land and building, after 24 months, long-term, that means up to 24 months, short-term. Other asset, after 36 months, long-term, then it means up to 36 months, that is short-term. For example, other asset, gold, drawings, paintings, unlisted debenture, specifically is for 36 months concept. So you can read the provision, it's simple, of course. So what is short term? That means those assets which are not long term will be treated as short term capital asset. Okay. Now the first numerical concept under capital gain is here. That is called indexation. And we can say first numerical or first different concept, because till now we just read the basic thing. We just discussed section 45, that is our charging section. We discussed the meaning of capital asset, section 214. We discussed the meaning of transfer, section 247. We discussed the format, what is the format regarding that. We discussed the meaning of long-term capital asset and short-term capital asset. Now the concept of indexation, and that is only applicable on long-term capital asset. It is only applicable in case of long-term capital asset. Now, what is the concept of indexation and how it came or why it came? The concept of indexation says a very simple thing. It says, suppose there is Mr. A. There is Mr. A and he bought a building in 2006 for rupees 20 lakh. Clear? Now he wants to sell this building in 2022-23. And the selling price is, for example, 90 lakh. So if in a layman language, if I'll ask you to calculate the profit or capital gain on sale of this, so we will take sale consideration 90 lakh. We will deduct the cost, is 20 lakh. And he would have been a profit of 70 lakh. That is long-term capital gain. Clear? But now the problem arises. When we are solving this question, we are taking the currency value. The sale price is the technically currency value of 2022-23. The currency value of the sale consideration we are taking for current year. But the currency value we have incurred for purchase, we are taking for 2006-07 previous year. So only in the case of capital gain had, it happens that we are taking value, but the currency value is for two different years. So the value has been taken for purchase is always from some different year, and the value of sale is always for the previous. So that is a problem. The assessee says that the sale consideration currency value you took for 22-23, but the purchase currency value you are taking from 2006-07. So the monetary value of this 20 lakh, the monetary or the currency value of this 20 lakh, which was 20 lakh in 2006 and 7. If we find the currency value, we should take the currency value of this 20 lakh. We should take the currency value of this 20 lakh in 2022-23 also, because we are taking the sale currency value for 2022-23. So for the purpose of similarity of the provision, if you are taking the currency value for sale consideration for 2022-23, then you should take the currency value of 20 lakh also as per 22-23, because whatever I can purchase out of that 20 lakh in 2006-07. Now I need to spend more money for the purchase of that same thing in 2022-23, because due to inflation. Inflation is a disease of money. It actually reduces the money value. So whatever 20 lakh I have technically spent in 2006-07, that currency value is more in 2022-23, or we can understand it in a simple way. Whatever you could purchase out of 100 rupees 5 years back, for purchasing the same thing today, we need to spend generally more amount. So it is happening because due to inflation. That is, inflation is a disease of, there's a definition of inflation that is called, that the disease of money is technically inflation. It's a kind of a depreciation in the money value. So because before 5 years, if I could purchase something in 100 rupees, I need to spend more money to purchase the same thing today. The same concept has been given by the assessee to the department, that if you are taking my sale consideration 90 lakh for currency value 20 to 23, then you should take also the currency value for this purchase price for 20 to 23. And department say, yes, you are right, because this currency value should be higher than that. So to streamline this value, to streamline the purchase value, we need to take now the currency value for purchase price also for 20 to 23. And for that purpose, we need or we take the help of indexation. So indexation technically is nothing, just to find the purchase currency value which is in the previous year in which we purchased this property. So to calculate the currency value of that purchase amount in the year in which relates, and to convert that currency value in the previous year in which asset has transferred. That concept is just called indexation. We can say the transformation of currency value. We should use transformation of currency value from the purchase year to the sale year. That is called indexation. How it's need to be done? Let me explain you. So for the purpose of indexation, government income tax made an index sheet. It like this. It started from 2001-02, previous year. Indexation value as per previous year. So government say, if anything you purchased in 2001 and 2 for 100 rupees, then for previous year 20 to 23, government has notified that due to the inflation, the value should be 331. Listen me carefully. We are not saying that whatever you can purchase in 100 rupees in 2001-2, the same article now is for 331 rupees. No, it is more costlier than that. But government has shown this list as per the inflation concept they have. So these are fixed value, we cannot change it. So as per government, if the currency value was 100 rupees in 2001-2, so for 20 to 23, now this is 331. Before that year, that is 21-22, I guess it was 317, etc. So on. So government gives all the index from 2001 till 2022-23. All the years we have index, it's on notes also. So now suppose if any asset we purchase for 10 lakh rupees in 2001-2, and if you are going to sell this property in 2022-23 for 180 lakh. So now how capital gain will be calculated? Let's see, if there is no indexation concept, then of course the profit will be 170 lakh. So assessee need to pay tax on long-term capital gain 170 if there is no indexation concept. But because now we have the indexation concept, so what we need to do? Sale consideration is 180. Now we need to deduct index cost of acquisition. Now need to change this value from this year to this year. For this, a formula has been prepared which say cost of acquisition divided by the year in which you purchased that asset. So the index of that year was 100. So it says you need to deduct the cost of acquisition with the year of index of purchase, which will be given in question. Do not bother. You should remember only one index, the current year, and the first index, that was 100. All other index will be given in question if that is related to your question. So it says it should be divided by the year of purchase index. We have a detailed formula. I just giving you an example. Purchase year index and multiply with the transfer year index. General formula say like this. So technically the value now will be increased. That will be 33.1. Why I am calculating this? So this will be my cost to deduct from my sale consideration. So you can see that will give advantage to reduce your capital gain. Now the capital gain is 146.9. So indexation is nothing. Indexation concept work like this, that whatever you have purchased in earlier year and spend that amount, then due to the help of indexation concept, you can increase that value, you can transfer that value, you can transformation that value as per previous year index. I will explain you in detail of the example. For the time being, I just explained the concept of what is technically the concept of this. So I have written the theoretical part also, so you might be able to read and understand it more clearly. So if you purchase a building in 2005 for 10 lakh, you can read it yourself, of course, because I've explained the same example almost to you. Under section 48, for computation of long-term capital gain, the cost of acquisition and cost of improvement will be increased. By applying the cost inflation index. Once the cost inflation index is applied to the cost of acquisition and the cost of improvement, we will do the same thing with the purchase price and the expenses incurred after purchase of that property. Okay. And cost of improvement, it becomes index cost of acquisition and index cost of improvement. Next, index cost of acquisition formula, which has been like this: cost of acquisition, which has been given in question, index for the year in which asset is transferred, that is for our previous year, that is 331 generally. Index for the first year in which asset was first held by assessee, that means technically the purchase year index. If you purchased in 2005-6, then previous year 5-6 index we need. If you purchased in year 2010-11, then we need the index of 10-11. It will be given in question, do not bother. But it has been written one more thing, or financial year 1-2 index, whichever is later. What is the meaning of this? It's a very interesting meaning. So the exact formula is like this. It says, for example, you purchased any property in 1995-96 or rupees 50 lakh. Clear? And you sold that property in 2022-23 for rupees 300 lakh. Now one problem will arise. The problem is this, that when you are going to apply this formula, it will say that cost of acquisition multiplied transfer year index. So as per formula, I write down the value, cost is 50 lakh, transfer year index is 331. And denominator says purchase year index. So now the purchase year is 95-96 and we do not have any index for 95-96 because the index concept has been given from 2001-2. So I do not have any purchase year index for 95-96. So department made the denominator concept is like this: purchase year index or 2001-2 index, whichever is later year. Why it has been made? This concept has been made because if any asset has been purchased before previous year 1-2, So still we have going to our index. So in this concept, there is no index for this, but for 1, 2, we have index of 100. So we can write out over 100 and we have the solution for the capital index cost of acquisition. So we can say it like this. If purchase year, in short, I can say if purchase year is on or after 2001 and 2, then we will always have purchase year index automatically. And if it's before 2001-2, then the concept says purchase year index, which will not be available, of course, because index is before only 2001-2. So in that case, always index 100. Because if asset is purchased before 1-2, then there will be no index for the purchase year. And it says the purchase year index or 1-2, whichever is later. So in that case, the later will always be the 1-2 year index. So if asset is purchased on or after year 1-2, then purchase year index. If it is before that, then always 100 will be your denominator index. Understand? After this concept, we are going to take your problem and then we will go for a break. So this provision has been inserted because of those properties, those have been purchased before 2001. So we will always have our index value, either we have the purchase index value or we will have 100 as your index value. So you can apply it like this, 1-2 index or purchase year index, whichever is later. Same concept, almost same concept is for index cost of improvement. Cost of improvement, that expenditure of capital nature you have spent or incurred on that capital asset. Transfer year index, sale year index, but in the denominator, there the year in which improvement took place only can be taken. This is a very interesting thing. Only that can be taken, which is so the concept says this concept says that cost of improvement index for the year in which asset is transferred, but index for the year in which improvement took place we can take only in this case. There is no concept of 2001-2 or later. That means cost of improvement, if it is before 2001 and 2, that will have no treatment under capital gain chapter. So only those cost of improvement can be indexed, which has been done on or after 2001. I will give an example for that, do not worry, in which you can understand the concept of cost of improvement and cost of acquisition. Clear? Next is, these are the cost of inflation index. From 1-2 it was 100 and till now it is 331. The note is saying this. That cost of improvement incurred before 1/4/2001 will be ignored. Why we need to ignore it? Because we do not have index, and in the denominator it says for the purpose of cost of improvement only the year of improvement index we need. So if there is any improvement that is before 2001-2, we do not have any index value for that, so we need to ignore it. But cost of improvement done by SSC or previous owner, both are liable to deduct by SSC, etc., provided expenditure incurred on or before 1/4/2001. Do not worry, I will explain with you an example. I will write a full example for it after the break, so you understand what I am saying. First of all, we need to read the provision. Cost of improvement in the nature of capital expenditure will be considered only. And any cost of improvement in the revenue nature will not be considered. So any cost of improvement in revenue nature will not be considered. Only the capital nature cost of improvement will be applicable. indexation not apply in case of debenture and bonds. On some asset, there is indexation not applicable. Indexation is applicable on all long-term capital asset, but this is exception. If you have debenture and bonds, and even if it is long-term, you cannot apply indexation provision. On shares you can apply, but you cannot apply on long-term capital asset. If these are debenture and bonds, indexation will not applicable, except capital index bond. But if these bond name is capital index bond, the name already include the word index, then indexation will apply. So we can say on all long-term capital asset, we can apply the concept of indexation, except debenture and bonds. But this capital index bond is liable to indexation. So this is technically exception of the exception. So these are normal. Capital index bond liable to be indexation, except capital index bond, no bonds and debenture liable for indexation. And this bond also. In case of depreciable asset, there will be no indexation. In case of depreciable asset, indexation concept again not applicable. Why it's not applicable? We will discuss under section 50. Okay, so now I am going to take the query. Then we will go for a break, and then when we come back, we will discuss a short story if you would like to hear. And then on numerical, an example regarding this indexation concept, the cost of improvement concept. Till now, up to page number 5, whatever provision we have read, I will give you a small example, because in capital gain, almost in every numerical treatment, I have to give you an example. Without example, it will be difficult for you to understand. Okay. So let's see the queries. Okay. Question was, yeah, okay. Rama S is asking, sir, if transfer of building under relinquishment to charitable trust, it will become under capital gain, it will be exempted. If your transfer relinquished to any person, it does not matter. It is a capital gain thing, but because section 47 is going to exempt this kind of transfer, so definitely it's a part of capital gain, but because it is not treated as transfer, so there is no calculation of capital gain you need to do. Okay. Next is Sankaran is asking, under gift or will, both cost and transfer price will be treated as same? Under gift and will, the transfer price, that means sale consideration, will be zero always. Even it's a will or it's a gift, same thing. In any case of relinquishment, the sale consideration will always be zero. Whatever cost you have paid at the time of purchase, that is your cost. So there will be loss, and it's going to be exempted under section 47. Okay. Vaishali is asking, section 45 and transfer of land of father to son is not capital gain. Exchange में sale price is considered of what we give or received of F&B. तो वैशाली ट्रांसफर ऑफ लैंड, अगर फादर अपनी लैंड गिफ्ट करते हैं, अगर वो बेचते हैं अपने सन को, तो टैक्सेबल होगी फादर के हैंड में. ओके. अगर कोई अपनी लैंड गिफ्ट करेगा अपने सन को, तो टैक्सेबल नहीं है, बिकॉज दैट इज गिफ्ट. बट अगर बेचा है, पैसे लिए हैं फादर ने, तो टैक्सेबिलिटी होगी. पहला आंसर तो ये हुआ. नेक्स्ट आप पूछ रही हैं कि एक्सचेंज में, मैंने बताया था एक्सचेंज में जो एसेट आएगी आपके पास, मेरे पास ज्वेलरी है और मैं उसे एक्सचेंज कर रहा हूं किसी के साथ शेयर्स के बदले, तो जो शेयर्स मुझे मिलेंगे उनकी मार्केट वैल्यू मेरा सेल कंसिडरेशन मानी जाएगी. वो आपके क्वेश्चन में गिवन. ओके. नेक्स्ट इज team owner answers you have given to me. Good. Vaishali is asking, sir, if some property is purchased in HUF and after some time transfer ownership one property to one brother to another. I am not understanding. You are talking about same property which has been in the HUF or just separate property which has been transferred by one brother to another. Please clarify so I can answer it correctly. Okay. Sir, what if asset purchased before 2001-2 and purchase value is not given? Bhumika, in that case, fair market value will be there. We are going to read a concept of that is cost of acquisition. This is cost of acquisition. We will be discussing how the cost will be find out. Till now, we are just discussing the meaning of capital asset, transfer meaning, long term, short term, what is indexation, how index values apply. But how the value, how the cost of acquisition will be find out, we have a complete diagram for it. So just relax. We are going to discuss it after the break. Okay. Next is Vishwanatha Reddy is asking, what if Mr. A entered into an agreement for his house sale, okay, with Mr. B, and Mr. A received 50% of sale consideration from Mr. B and not handed over possession to Mr. B. So if possession has not been given, that is not going to treat it as a transfer. Do not worry. So that is not a transfer until we give the possession and receive the money. Both should be done. So if possession has not been given, Vishwanathan Reddy, then it's not a transfer yet. That's kind of an advance of in the hands of Mr. A from Mr. B. That's just an advance value. There's nothing treatment under capital gain till now. So I have taken the query, sir, same property. Okay, Vaishali is asking same property. So you cannot transfer it like this. If you technically bring any property in HUF, and if the property is transferring from Mr. A to B, you might be talking about the partition. So partition of property, house HUF property is also not taxable. That is also exempted. Section 47 will discuss this provision after this. So how the transfer is going to be taxable or not, all these kind of provisions are part of section 47, which will describe, explain in detail everything which is in transfer definition. Okay, so I'll be back after 10 minutes. So you also go have your tea, coffee, etc. And we are going to see each other after 10 minutes. So Maniji, can we Welcome back, everyone. My future chartered accountants. Welcome back after your tea, coffee, etc. So I guess you all are refreshed now after that break. So now this is our story time. So let's see who are ready to hear the story. A very short story. So if you wanted to listen to the story, I am waiting for a response. It's a like 2 or 3 minute story, but definitely going to help you in your study also. So let me see how many of you are interested in listening or are ready to listen that story. If you are not interested, then I am moving on to our my notes. Then I am moving on to our. So let's see. Till now, I did not receive anything. Okay, so Sudhanshu is ready to listen. Very good. Diksha, I need more. I guess you are not interested in hearing that story, so I guess we should move on to our notes. So we should skip the story, I guess. Only 2 of you need to listen that. So I guess most of you are like sleeping or what? Okay. More has come. Miss Singh Rajiv Kumar is here. Okay, ready. Prasanna, Kavita, Arya. Very good. Look, that's what I'm trying to make you understand. When I said that I'm going to tell you a story, you all must be very excited to listen to that story. And that should be for our study also. When I'm saying I'm going to teach you capital gain or any faculty is going to teach you anything, you should be like that excitement you should have. That yes, wow, today we are going to learn something new. So that kind of interest we are having for movies, for anything, etc. You should have for your study also. From that day, you will feel that your studies are not difficult. Because once you create it, and that interest going to make your future also. So we are going to discuss the story, and of course, it's going to be in Hindi. I'll try to mix it with some English also. So if somebody of you do not know Hindi at all, so he or she might be able to understand it also. So story ये है, एक स्कूल था. School we all know of course. Good. एक स्कूल था और उस स्कूल में एक टीचर का बर्थडे था. एक दिन एक टीचर का बर्थडे था और वो अपने क्लास में आए और सब बच्चों ने बर्थडे विश किया और उन्होंने बच्चों से कहा, बच्चों मेरे पास आज तुम लोगों को देने के लिए 2 चीजें. उन्होंने अपना एक बैग में से एक केक निकाला. दैट वाज अ ड्राई केक इन अ पैकेट. एंड ही आस्क्ड के कौन बच्चा ड्राई केक खाना चाहता, who wants to have this dry cake. And of course every student of class raised his or her hand. Yes sir, we need this cake too. Everybody was. So he said okay. उन्होंने पैकेट से वो केक निकाला. He cut a piece of a cake and put it on a paper plate. Okay. Then he again उन्होंने अपने बैग से एक 500 रुपीस का नोट निकाला. उन्होंने कहा कौन बच्चा ये 500 रुपीस चाहता है, ये भी बताओ. So everybody again raised their hands. Yes, we need this 500 rupees. Of course, everybody in the class. So he said okay. So the cake piece, that dry cake piece, what he has in his paper plate, उन्होंने उस केक को फ्लोर पे फेंक दिया, गिरा दिया. That cake technically fall down on the floor and वो गंदा हो गया, dust, dirty, etc. And उन्होंने कहा, oh God, this cake has been by mistake, मेरी मिस्टेक से गिर गया और ये गंदा हो गया. तो उन्होंने वो फिर से वापस केक को उठाया और पूछा कौन बच्चा इस केक को खाना चाहता है. And nobody wants to eat it. Everybody was saying, oh shit, it's bad, dirty. Nobody was interested. Everyone was saying, ew, no. So then उन्होंने वो जो 500 रुपीस का नोट था उसे नीचे गिराया फ्लोर पर. वो भी गंदा हो गया, डस्ट, डर्टी. उन्होंने उसको वापस उठाया और पूछा किस को ये गंदा नोट चाहिए. And what happened? Everybody wants it. All the students of the class needs, yes, we want this note. Okay. उन्होंने वापस जो केक था उसे थोड़ा क्रश करा और वापस से नीचे गिरा दिया. वो और गंदा हो गया और खराब हो गया, एंड वापस उसे प्लेट में रख के पूछा कोई है जो इसको खाना चाहता है, एनीबडी इंटरेस्टेड? अगेन एवरीबडी इज नाउ मोर feeling bad even after seeing this. No, we don't need it, it's bad, it's dirty, we cannot eat it. So किसी को भी वो केक नहीं चाहिए, किसी को भी, कि वो खराब हो गया था, डर्टी था, क्रश्ड हो गया था। एंड देन उन्होंने जो 500 रुपीज का नोट था उसको क्रश किया अच्छी तरह, फाड़ा नहीं, क्रश किया और जमीन में फेंका, उसको और अच्छी तरह गंदा किया जमीन में, उसको उठाया और पूछा हु वांट्स इट, एंड अमेजिंगली एवरीबडी स्टिल वांटेड, सबको चाहिए, सबको। सो द मोरल ऑफ द स्टोरी इज व्हाई एवरीबडी वांट्स दैट नोट, बिकॉज इट हैज वैल्यू, उसकी वैल्यू थी, वो कितना भी गंदा था, कितना भी क्रश था, कितना भी खराब था, बट उसकी वैल्यू थी। और आप लोग भी वैसे ही बनो, जब तक आपकी वैल्यू है यू विल बी इन डिमांड। कोई फर्क नहीं पड़ता कि हम कितनी बार ब्रेक डाउन होता है हमारा, कितने ब्रोकन है हम, कितने मुश्किल में है, कितने मुश्किलों से हम सीए बने हैं, या अपनी जर्नी में आपने क्या क्या सफर किया है। बट वंस यू विल अचीव योर टारगेट टू बिकमिंग अ चार्टर्ड अकाउंटेंट, आपकी वैल्यू वही नोट जैसी रहेगी, बिल्कुल वैसी। अगर आप इस कोर्स को छोड़ देंगे योर वैल्यू विल बी गॉन। माइट बी कि आप कुछ अच्छा और कर लें, आई एम नॉट सेइंग कि कोई इस कोर्स को नहीं कर पाएगा तो उसकी लाइफ में कुछ नहीं होगा, बट अगेन अगर आप कुछ भी ऐसा करते हैं जिससे आपकी वैल्यू बढ़ती है तो आप डिमांड में रहते हैं। तो आप कितनी बार गिरते हैं, फेल होते हैं, लोग आपको ब्लेम करते हैं, आपके ऊपर यू फील डर्टी बिकॉज ऑफ द ब्लेम्स एटसेट्रा, आप फेल होते हैं, आप ब्रेक डाउन हो जाते हैं, आपको लगता है कि किसी ने क्रश कर दिया है, एवरी टाइम डिप्रेसिंग होता है काफी कुछ। बट बिलीव मी, अगर सच में आपकी वैल्यू रहती है, यू नीड टू फाइट, यू नीड टू फाइट, यू विल बी लाइक अ 500 रुपीज नोट। तो आपकी डिमांड हमेशा रहेगी, हमेशा, चाहे कितनी भी बुरी कंडीशंस के बाद आपकी वैल्यू बनती है, बट वैल्यू हमेशा आपकी रहेगी। वो कैसे बनी है इससे किसी को फर्क नहीं पड़ता। So that 500 rupees has value in itself for all the time. That's why everybody wants it. So be like that. So might be आप सब में से कुछ लोगों को अगर ये समझ आएगा, ये कोर्स भी बिल्कुल वैसा ही है। इसमें बहुत सारी प्रॉब्लम्स आपको लगेंगी, पढ़ने में डिफिकल्ट है और भी प्रॉब्लम्स, बट लेट मी टेल यू, once you will be a CA, you will always be a CA. Just a second. मूविंग ऑन टू आवर नोट्स, आई होप आप में से कुछ लोगों को ये स्टोरी अच्छी लगी होगी। अच्छी लगी है तो वेरी गुड, और किसी ना किसी को तो अच्छी लगी है, किसी को भी एक को भी अच्छी लगी है ना, दैट्स बेटर, क्योंकि आपका एफर्ट कितना बड़ा है, कितना ह्यूज है, इससे फर्क नहीं पड़ता, आपका एफर्ट होना चाहिए। मेरा एफर्ट ये है कि मैं चाहता हूँ कि जो भी मैं पढ़ा रहा हूँ, वट एवर आई एम टीचिंग, वेदर इट्स मोटिवेशनल और इट्स स्टडी पार्ट, तो अगर आप में से कुछ बच्चों को भी उससे फायदा हो रहा है, that's what I wanted, that's what institute want, कि आप सबका फायदा हो, बट वी जस्ट नीड कि जो भी सिंसियर हैं और जिनको इससे फायदा हो रहा है अपनी स्टडी में, सो उनके लिए ऑफ कोर्स इंस्टीट्यूट इतनी मेहनत करता है, एंड वी आर आल्सो डूइंग दिस। सो मूविंग ऑन टू आवर प्रोविजन नाउ, ओके। सो टिल now we have discussed capital gain. Let me see if there is any query. Okay. Diksha is asking if Mr. A purchased a land for agricultural from Mr. B without consideration, but with a contract that Mr. A will give a part of yield on agricultural to Mr. B. So will this situation be taxable? What is that? I am not understanding. You are talking about the agricultural produce. If somebody is giving to someone else, that's kind of an agricultural income, or what is it? Mr. A purchased a land for agriculture, Mr. B without. Okay, you are talking about the possession condition, I guess. Transfer definition, point number 5, I guess. So if I purchase a land for agriculture from Mr. B without consideration, but with a contract that Mr. A, so consideration might be monetary or non-monetary. So whatever amount of consideration has been decided, there must be some consideration, full value must be decided. So this in the registered agreement, in the actual agreement, the exact value of consideration, which might be 50 lakh, has been decided, but that will be given over a certain period of time. In that case, yes, it's a transfer. The 50 lakh will be treated as your consideration. Whether it's received today or tomorrow does not matter. Okay. Okay, Kavita is saying story is required. Sir was waiting since the day you said, even today before the lecture, you said I was like, what would be in the story? Okay. Next day, next class also we will discuss a new. I'll try to discuss a new story, and if any one of you feel good after listening to a story, that's what we want, of course. Okay. Chalo. There is no more query over here. So we are moving on to our section 49. It's a very, very important section. You can see, if you will understand the provision till now, the capital gain format is too easy to solve till now. Okay. We need sale consideration. In 99% cases, sale consideration is given in question directly. There is nothing complicated. You need to find it out. No, it's just given directly into the question. So it's very easy to find out the net sale consideration in the question because it's a part of question. The fight is just to find out the correct cost of acquisition and index cost of acquisition. Let me give you an example before starting to this topic. As I've told you that after break, I will give you an example. So the provision will be more clear to you. Suppose there is Mr. A. There is always a Mr. A. I don't know. Okay. So there is a Mr. A who bought a building on, you can take date of 10th July 1996 for rupees 5 lakh. He has done cost of improvement on 10th November 1999 for rupees 1 lakh. Then he done some cost of improvement on 5th March 2006 for rupees 2 lakh. He sold this property for rupees 60 lakh on 6th October 2020. Now we need to calculate the capital gain. So we will write down that income under the head capital gain for assessment year 23-24. First of all, it's a long-term asset or short-term. The asset is long-term. We need to calculate the period of holding. Period of holding means the date of purchase and the date of sale duration. So it's purchased in 1996 and sale is 2022. So for building, the time limit is 24 months. We have read in the definition of long-term, short-term. So it's exceeding 24 months. So that means it's a long-term capital asset. So in every question, you first need to check the period of holding to decide whether it's a long-term or short-term, because if it's a long-term, then we have to apply the indexation concept. Because it's long-term, so we need to apply the indexation concept also. Before that, first of all, what will be the sale consideration? That is, of course, 60 lakh. Now need to deduct index cost of acquisition. So for index cost of acquisition, 5 lakh is the cost of acquisition. If any property purchased before 2001, then we need to compare it for FMV also. That concept will come under section 49. So for time being, I am taking this index cost of acquisition as my cost of acquisition. Now we need to multiply it with 331. And now the denominator index will be 2001 index or 1996 index, whichever is later. So I've told you that if any asset has been purchased before 2001, always index will be 100 in this case. So whatever will be the amount, that will be my cost, index cost of acquisition. Then I need to deduct index cost of improvement also. Now, any improvement which has been done before 2001 is irrelevant. So this is before 2001, we need to ignore it, because even if you will try to solve it, we need to try to solve it. It will be like this: 1 lakh cost of improvement, 331. And the denominator say the index of the year in which improvement took place. The formula does not say whichever is later. It just say you have to use the index in the year in which improvement took place, what we do not have. So if you solve this, there will be nothing. So that's why I always ignore this. Improvement done after this year can be considered, and that is rupees 2 lakh into 331. It has been done in March 2006. So which previous year, 5th March 2006 belong? It is 2005-06 index we need to solve it. So it will be given in question. Let me see what was the index for this year. 2005-06 previous year index was 117. So for denominator, we will take 117. It will be given in question. Do not bother about it. Whatever value will come, need to deduct. That will be my long-term capital gain. Okay. So the cost of improvement concept, the index cost of acquisition, how to apply the formula, this implementation I have just discussed with you. Now moving on to a very important concept, that is cost of acquisition. In examination, you need to understand that cost of acquisition should be find out very cautiously, very focused, because if cost of acquisition is wrong in your question, you will get nothing in the solution, because sale consideration has already been given in the question. So examiner expect you to just find the correct cost of acquisition. Clear? So cost of acquisition is a complete and very confusing provision. If we'll try to learn these cost of acquisition provision, these are very, very confusing. And that will be really complicated. So I have made a diagram to make you understand how to find the exact cost of acquisition. Clear? One by one, I will explain you. I'll upload that chart presentation today only after the class also, so you can find it out on the portal. For time being, I am going to teach you one by one for the cost of acquisition concept. Okay. So capital gain, we are discussing cost of acquisition for the purpose of capital gain under section 49. It's a huge chart, so might be we need another page also. Just stay with me. This whole diagram has been already made by me, and I'll upload it on the portal after the class, so you can check it out from there also. For time being, you should be with me, understand how to calculate cost of acquisition in case of different situations. So first case, we can say case number A. We need to find the cost of acquisition in case of goodwill of business. Then if you have copyright, patent, trademark, etc. If you can see, we are talking about technically the intangible asset. They all are intangible asset, including goodwill of business. And if we can see that except the goodwill of business, they all are kind of a license or a right. So copyright, patent, trademark, etc. and goodwill of business. So if it is in question, you need to find out the cost of acquisition for any intangible asset, including goodwill of business. Then the provision says whether it is purchased on or after 1st April 2001 or before 1st April 2001, the provision will remain the same. In some asset, we will see later in this diagram, in some asset, the provisions are different. If you purchase any asset before 1/4/2001, the provision is different. If you purchase any asset on or after 1/4/2001, the concept is different. But the good thing is, in case of intangible asset, the provision are same. It does not matter when this asset has been purchased, whether before 1/4/2001 or after. So if you have goodwill of business, copyright, patent, etc., if you have this thing, then either it will be self-generated. Self-generate means you did not purchase it from anywhere. You have written a story like Harry Potter, etc., and you have copyright of it. So this is your story. You have written a book, and that copyright stay with you. So there are no cost involved in writing that book or the copyright of that book. That's your self-generated. If you have a business and you started it from yourself, and now you are going to transfer that business to someone else. So the goodwill of that business has been generated by you. You did not purchase it from anywhere or from anyone. For example, there is a shop which has been started by Mr. X, and it's a very famous shop of that area. And now Mr. X is transfer your business. He's transfer his business and charge 10 lakh rupees for goodwill for his brand name of shop. So this goodwill will be a capital asset. And because he's charging money, so it's transfer and it's a capital asset also. So sale consideration will be 10 lakh. But cost will be, there is no cost involved because this shop has been started by him. So he did not pay anything for goodwill because due to his sincere work, due to his good services, due to his good clientage, he create his goodwill in the market. So technically, he did not expense anything on goodwill expenditure. So cost will be nil because this, if any intangible asset has been self-generated, then the cost of that intangible asset will be always nil. So full 10 lakh is going to be taxable as his capital gain income. But suppose the person who purchased his shop and paid 10 lakh for goodwill, X transferred this shop to Mr. Y, and Y paid 10 lakh for goodwill. So technically, Y paid amount for goodwill. So if this shop is again sold by Mr. Y to any other person, suppose Mr. Z, and now Mr. Y charges 12 lakh for goodwill. Then when we will calculate the capital gain for Mr. Y, then this goodwill is not self-generated. This is purchased. So if this is purchased, then the cost of acquisition will be purchase price always. So in case of Mr. Y, if you will try to calculate the capital gain, then the sale consideration will be 12 and cost is 10, not 0. So cost will be nil only for those person having above asset, and that is self-generated. For example, I wrote a book, a new novel, suppose, and I transfer my copyright to someone for 5 lakh rupees. So that is self-generated. My cost will fall as per point number 1 and self-generate will remain 0. But to the person to whom I transfer my copyright for 5 lakh rupees, he transferred that copyright to someone else for 6 lakh. So in this case, now his cost will be 5 lakh and the gain will be 1 lakh. So this is very simple. In the question, it will be given that whether these things are self-generated or purchased. So if it is self-generated, then do not take FMV, etc. given in question to confuse you. The cost will be always nil. And if it's purchased, the cost will be purchase price. As simple as that. Okay. Now you can see Goodwill of business we were talked about, but not about the goodwill of profession. The difference between goodwill of business and goodwill of profession is this, that the goodwill of business is stay with the business. Who is the owner does not matter. Even the owner changes, the goodwill of that business remain with the business. It does not go with the owner. But goodwill of profession is always stay with the profession, the professional person. It stays. So wherever the professional go, the goodwill of that profession follow. Generally, so you must have read the nature of goodwill like cat goodwill or dog goodwill. So conceptually, goodwill of business is like cat. So it do not go with the owner. It's not that faithful. But goodwill of profession is technically dog nature. It stay with the professional person. But we have two kinds of goodwill of profession. One is individual, or we can say personal nature. And one is commercial nature. Like there's a doctor who is running his clinic in some place. So if he leave that place, in that case, wherever he will go, his goodwill will follow him. So it's in a personal nature, and you cannot transfer technically your personal nature, goodwill cannot be transferred. For example, a doctor run his clinic, and doctor name is, for example, Abhishek. Okay, Dr. Abhishek is running his clinic in a place, and he's very popular there. Now he's switching his business to somewhere else, and some other doctor is now come to his old place to running his clinic. So can the other doctor run that clinic with Dr. Abhishek name? No, not possible. So he cannot use his name because it's in the nature of personal. Like I am a chartered accountant. Can I transfer my degree to someone else who is doing a CA and not able to clear it? If I transfer is it possible to transfer my degree to someone else? Is it possible to you all to transfer your 10th mark sheet marks to someone else? For example, if there is Mr. A, he scored 93% in 12th, suppose. So he's very happy. He's in tears due to happiness. And his best friend, he scored 39% in 12th. He is also in tears. Sad. So the boy who got 93% gives his original mark sheet to his friend that keep this mark sheet with you. Now your marks is 93% and mine is 39%. Is it possible? No. You cannot transfer your personal goodwill of profession. It's impossible. So because it cannot be transferred, so there cannot be any capital gain concept applicable. It is not applicable. Because transfer is the basic condition. There is a capital asset, there should be transfer. So personal nature, professional goodwill cannot be transferred. But commercial nature, professional goodwill can be transferred. For example, there is a CA firm having 4 partners. Okay. And they all 4 are leaving the firm, but 4 new partners wants to join that firm. So in that case, goodwill of old firm can run because it's a partnership firm. So new partners can come into the same partnership firm. And for that, the old partners charge amount for consideration because for experience, etc. So in that case, goodwill can be transferred if it is for commercial nature. And the same concept will be applicable. Same concept. Does not matter before or after 1/4/2001. Again, if it's self-generate, it will always be nil. If it is purchased, purchase price. Same concept will be applicable. So we have read the all intangible assets provision, goodwill of business, copyright, patent, trademark, goodwill of profession, etc. So in case of goodwill of profession, always remember if it is question is given, it's a personal nature, then it means it cannot be transferred. And if it is commercial nature, then only capital gain will arise and cost will be decided as per the case. Same concept self-generate and purchase, there is no difference. Now moving on to our third concept. Case C. Now case C is regarding shares. And it's having three different situations or three different kinds of shares we are talking. It says ordinary share. I think we need separate place for this. So I am solving C on the separate part. So C is for shares. There is ordinary share. Then we are having bonus share. You all must know what is the meaning of bonus share, okay? And the third one is right shares. So ordinary shares are normal shares which has been offered by the company in the market or directly via IPO. It's very simple to find the cost of acquisition. And now this is the case if these have been purchased after 1/4/2001. If we purchase ordinary shares before 1/4/2001, there's a separate concept that is going to be discussed later. Same in case of right share, we are talking about the provision regarding 1/4/2001 or after. Before 1/4/2001, we have separate provision. For bonus share, we have both provision over here. For example, ordinary shares provisions is very simple. Either you will be purchasing it from stock exchange. If somebody has purchased them from stock exchange, or somebody must have purchased directly from the company in case of IPO, FPO, etc. So both have same provision that if you have purchased ordinary shares on or after 1/4/2001 from stock exchange or company, then the purchase price cost will be your purchase price. There is no difference, same concept applicable. I hope it's clear. Next is bonus shares. So bonus shares, if you got these bonus shares before 1/4/2001, we have separate provision. And if after 1/4/2001, on or after 1/4/2001, we have separate provision. Technically, what is bonus shares? If any shares has been received by you for free, that is called bonus shares. So in both cases, whether they have been received by you before 1/4/2001 or after 1/4/2001, they both have received without paying anything. But the treatment of cost acquisition is different. That's why I need to bifurcate them. So if these have been purchased before 1/4/2001, then the cost of acquisition will be fair market value as on 1/4/2001. Simple. This FMV will be given in question. Technically, you receive these shares free of cost. But department say we will take the FMV of these shares on 1/4/2001 as your purchase price. Clear? And if you have received these bonus share on or after 1/4/2001, the cost will remain nil. The cost will be nil. Clear? I hope it's clear. Fine. So that was the treatment of bonus shares. Now moving on to the right share concept. The right shares, those shares which has been offered in the market at a higher value, but the existing shareholder can avail these shares at lower than market value, is called right shares. With the help of an example, for example, company issue shares in market, the market value is 100 rupees per share. Offer the right price. Right price is for existing shareholder. If existing shareholder wants to buy it, they can buy it for 90 rupees per share. So the existing shareholder, or we can say the old shareholder, have the opportunity to purchase these shares for 90 rupees. But a new shareholder can only get these shares from market, that is for 100 rupees. But the existing shareholder has one opportunity more. Either they can buy it for 90 rupees, or if they want, they can renounce, they can transfer, they can waive their purchase right to some other shareholder. For example, FMV is 100, right price is 90, and new shareholder, example 1, A, B, C, D, E, 5 new shareholder is in the market to ready to purchase it. So either the existing shareholder will purchase it, or if he says no, then A, B, C, D, anyone can purchase, or proportionately company can transfer share to these people. And the right is for the right to purchase at 90 is only with the old or existing shareholder. So if he wants to purchase, he can purchase at 90 rupees, or if he wants, he can renounce his right to anyone, A, B, C, D, or any person. So now what will be the situation in different scenario? One by one, we need to see it. So either we are going to see the treatment in the old shareholder hand, and what can be the treatment for new shareholder. So old shareholder having two situations, either he will purchase. So if he purchase right share, then the cost of acquisition of these right share will be 90 rupees per share. But if he does not purchase, but right renounced by him, right renounce, right transfer to A, B, or C, or to anyone. So if he renounce his right, for example, at the rate 2 rupees per share, then cost of acquisition will be nil for him, because he did not pay anything for the right. The right has been received by him because he was the existing shareholder for free. So he transferred this right for rupees 2 to the new shareholder. So the sale consideration technically will be 2 rupees, but the cost will remain 0. So in case of right renounce, the cost of acquisition in the hands of the old shareholder will be 0 always. He did not pay anything for the right. So if he purchase, the cost acquisition will be the purchase price, but if he did not purchase, then technically there will be no cost in his hand. So in case of old shareholder, the cost might be 90 rupees if he purchased. If he did not purchase, the cost will be nil. So full value, whatever he received on renounce right, will be his capital gain. 2 rupees will be his capital gain. Now for the new shareholder, there will be again two situations arise. For new shareholder, there will be two situations arise. Either he will not purchase the renounce right, he will directly purchase the share from the company, or the company directly allot these shares to the new shareholder. So if he purchase from the company, then the cost of acquisition will be the purchase price, that means 100 rupees per share. And if he purchase right from the old shareholder, he purchase right from old shareholder first, then he went to the company to purchase the share. Then the cost of acquisition will be the right price, that was 2 rupees per share paid by him, plus payment made to the company, that was total will be 92 rupees per share. So the benefit of purchasing right is this, that he will be able to purchase share at less cost, because for company now he is equivalent to the old shareholder. So if we going to purchase it from directly company, the cost will be 100. Otherwise, it will be 92. So this diagram has already been made. Is a in a chart presentation. I'll upload it today only. Do not worry. Now the last case. So this was our C case. Now the D case. A case was goodwill of business, trademark, copyright, etc. B case was goodwill of profession. C case was this share. Three kinds of cases: right share, bonus share, and ordinary. And now for any other asset. For any other asset, the concept says if it is purchased before 1/4/2001, if it is purchased before 1/4/2001, then the FMV on 1/4/2001 or the purchase price, whichever is higher, remember, whichever is higher is going to be your cost of acquisition. So if any asset has been purchased in 1995, then the purchase price is 5 lakh and the FMV on 1/4/2001 has been given 8 lakh, then 8 lakh will be your cost of acquisition. In 1995, you purchase it for 5 lakh and the cost FMV on 1/4/2001 has been now 4 lakh. Then the higher 5 lakh will be your cost of acquisition. So if it is purchased on or after 1/4/2001, it's very simple. Cost of acquisition is equal to purchase price. So this is the basic format. This is the basic format for our cost of acquisition. We have seen that this is a basic format for our cost of acquisition. We have learned the cost of acquisition for intangible asset, for goodwill of profession, goodwill of business. Then we discuss the provision regarding the shares and then the other. There are few special notes also regarding this. You can see in this format that in case of goodwill of business or goodwill of profession, or we can say case number A or B, it does not matter that asset has been purchased on or after 1/4/2001, the concept will remain same. Clear? For bonus share, we have provision what will be done before 1/4/2001, what will be happen on or after 1/4/2001. For other asset, which is point number D, we have the provision before 1/4/2001 and other also. So for bonus share, we discuss the provision both. What will be the cost of acquisition before and after 1/4/2001. For other assets, we just discussed that if it is before 1/4/2001, FMV or purchase price higher will be taken, otherwise the purchase price. But for ordinary shares and for right shares, the provision we discuss is just for if they have been purchased on or after 1/4/2001 for both right shares and for ordinary shares. So what will happen if we purchase ordinary shares or right shares before 1/4/2001 has been left? So we are just about to discuss it. It's a very simple concept. There's nothing new. So in case of ordinary shares and right shares, if they have been purchased on or after 1/4/2001, the cost of acquisition as per above chart we discussed. But if they have been purchased before 1/4/2001, then cost of acquisition will be, there's nothing new. You just need to compare it with the FMV. FMV on 1/4/2001 or purchase price, whichever is higher. So the same concept applicable in this case, the same concept is applicable what have been in the first case. Same. So why we did not made this concept also in diagram? Because that will be really difficult. The diagram will be very messed. Because in that case, I need to make the two subpart of all this one, this one, this one, and two subpart of this, two subpart of this, two subpart of this, two subpart of this. That will be more confusing. So to remove the confusion, you just need to learn one point, and that is very simple, that in case of right shares or in case of ordinary shares, if it is purchased before 1/4/2001, you just need to compare the purchase price with the FMV that is going to be given in the question, and higher will be your cost of acquisition. This diagram I will upload. You can check it out because that is the only diagram. So you can be very easily learn the cost of acquisition provision. If you try to learn the provision of cost of acquisition from theoretical provision, that is going to be really, really messed up and difficult. So now if you want, you can read it from the study material after reading the chart. So if you read through the chart, you will find it out that yes, that is now very easy. You can go through the provision with the study material regarding only cost of acquisition provision. So in my notes, it's from chart presentation only. I do not make these provision over here because it's very huge and complicated. Important clarification. Let me see the queries. Then this clarification, etc., will be taken up in the next class. Let me see the queries. Surjat base, I will not share the handwritten notes. I have made the computerized notes. Let me show you. I have those notes. Okay, so you can see. This is our chart presentation. I just made what we just discussed. We were discussing. This is over here. So I will upload these notes so you can see these notes, and that will be really easy for you to understand the concept. I have written each and everything in these notes, what we just discussed in our handwritten chart. Everything is here. You can go through it and you will find out that finding cost of acquisition cannot be easier than this. And if you are able to find the correct cost of acquisition, let me tell you, my future chartered accountants, you are able to solve capital gain very easily. The mess part is just only to find the cost of acquisition, because once you find the correct cost of acquisition, that means you can find easily the tax cost of acquisition. Cost of improvement is not a difficult task, it's very easy. So you are able to solve the numerical part very easily till find out the capital gain concept basic. We have more than that, exemption, etc. But till now provision is up to these provisions. So this is diagram. I will upload it. Do not worry. After the class, I am going to upload it in an hour. Okay. So moving on to our provision and queries. Any queries, you can ask me. So till now, there is no more query left. Okay, there's a query. Let me see. So period of holding would be the original holding is as for index cost of acquisition, we take 1/4/2001, but for holding will be from the normal purchase date. It cannot be from 2001. So if you have purchased any property in 1995 and the FMV is 2001, we are taking, but we will take the period of holding from the initial date. Okay, let me tell you one more thing. When the next class will be there, we are going to have a MCQ test again, as we always do. So do read the provision. Let me solve you a simple question, then we'll close the class. What somebody was asking, who was asking? Kavita was asking. Let me solve it for you. For example, Mr. A purchased a property in 1995 for rupees 10 lakh. The FMV on 1/4/2001 is rupees 15 lakh. The cost of improvement has been done on 10th July 2009 for rupees 2 lakh. This property has been sold off for rupees 90 lakh. Then computation of capital gain in the hands of Mr. So-and-so for assessment year 23-24. First of all, we need to find the period of holding. It will be from 95 till 2022. So period of holding would not be changed. So that will be long term. You need not to calculate how many number of year it has. If it's more than 24, you can directly write it down long term. Now the sale consideration will be 90 lakh. Now index cost of acquisition. So for cost of acquisition, because the asset has been purchased before 1/4/2001, we need to take the purchase price or FMV, whichever is higher. So higher is 15 multiplied by 331. Denominator index will be 100 because it is purchased before 2001. Now the index cost of improvement. So this value going to be deducted. Now interest in index cost of improvement will be 2 lakh into 331. And we need to take the index of financial year. Always understand the financial year based index is there. That is 2009 and 10. Whatever it is, you can find it out from the chart or it will be given in the question. Deduct it. You will have your long-term capital gain or capital loss. Clear? Okay. Sir, period of holding, I have solved this problem. Kavita, Vaishali, sir, right share may before 2001, then old share may renounce may. No, if there is renouncing provision, that must be have done in 10 or 15 days. So this concept of 2001 before in case of right renounce would not be practically applicable. If the question relate to the renounce of right, that must be in recent 2022 because company gave only 1 month or 25 days or 2 months to decide. So it cannot be happen that right renounce case before 2001 has been given in question. Okay. वैशाली लॉन्ग टर्म शॉर्ट टर्म राइट रिनाउंस में डज नॉट मैटर, इसमें मैटर नहीं करेगा. राइट रिनाउंस के केस में आपको लॉन्ग टर्म शॉर्ट टर्म मैटर नहीं करेगा. ओके. और इफ द परचेज शेयर, इफ द ओल्ड शेयर होल्डर इज एक्चुअली परचेजिंग, देन इट विल मैटर. राइट रिनाउंस वाले केस में बिफोर 2001 एफएमवी वाला कंसेप्ट एप्लीकेबल नहीं होगा. ओके. ओके. Vishwanatha Reddy is asking how to determine FMV as in 1/4/2001 in case of any other asset. FMV will be given in question. That is not our task to find it out what is the FMV in the question. It will be given in question from the registered valuer. Government need to know what is the fair market value exactly. So we need to just bother about how to solve the question. How to find the FMV, how to find anything else, that is not our concern. Okay, Mr. Reddy. So I guess all your query has been solved. So be ready for your MCQ, not now, in the next class, of course. And as I always say, please revise twice. That's my advice to make you wise. So we are going to see each other day after tomorrow in our second session of capital gain. Till that, please revise the provisions because capital gain is going to be little complicated after it. Till today, it's simple. And I believe everything is simple. If you're giving time, if you're going to revise that, everything is simple. Okay, nothing is difficult. So we will meet again day after tomorrow. Today's session is the end. Have a good day, everyone. See you tomorrow, day after tomorrow. Take care. Manish ji, can we